Hello and welcome to today's premium account market update for December 2016. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offered presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals, have over 18 years of experience in the financial services industry and licensed securities and derivatives advisor. The format for today's presentation, we look at the macro update driving equities. We roll through the ASX top 50 with a focus on FY 17 and FY 18 earnings. We look at technical trends and fundamentals that make up the portfolio allocations and conclude with a short-term Australian market outlook. The premium account service is a model portfolio of ASX 50 stocks. We utilise call options to enhance portfolio returns. We're focused on effective ownership around ex-dividend dates, generating above average cash flow, still allowing for capital growth, all in a strict investment mandate. And importantly, the assets all remain in your name. If you'd like to know more about the Investor Signals service, please contact me, leon@investorsignals.com. Moving straight into a graph of the US market, the Dow Jones has been performing very strong since Trump was elected. A big driver of this is the US financials, and I'll bring up a graph in a moment at JP Morgan and Goldman Sachs if you're just not familiar with the performance of those banking stocks over the last 6 to 8 weeks. But with the US market now trading on 17 times forward earnings, interesting, we're now really borrowing a lot of the anticipated performance or uplift in earnings into next year, and it really, there's no evidence that obviously the policies that Trump's going to implement will actually lead to a substantial pickup in earnings, given that there's a reasonable drag on global economic growth through the problems in Europe and in parts of Asia, and in particular, I guess you look at the export market in China, which is down roughly 10% on the same time last year, which is a reflection of the slower exports to, among other places, Europe as an example, that's still struggling to deliver substantial growth. So whilst we're bullish on US equities, we're a little bit cautious that this rally doesn't sort of get too far ahead of itself and ends up creating, the buy the rumour, sell the fact. We're in the rumour stage of all the great things that Trump's going to deliver. Maybe when he gets elected, when he takes presidency in January, there may be a pause in the rally, and the market will wait for a little further evidence that earnings actually picking up. So on that note, when you look at the third quarter earnings in the US for the September period, the S&P 500 roughly grew earnings around 4%. Keep in mind that companies are buying back shares still at a record rate. So really you'd have to say on the same time last year, there's really limited or no earnings growth in the S&P 500. Throw on top of that now in the latest quarter a US dollar that's been much stronger than it was in the prior quarter, and no material change in Europe or in Asia as far as GDP pickup goes. You would question why the December quarter is going to be too much better than the third quarter. Look, I think it's fair to say that the resource area of the market's going to probably exceed analysts' expectations, so that may be an area that helps lift the average earnings rate up. From a technical perspective, the Dow Jones has broken out of this resistance, which was what our base case was, so we've remained long equities on the assumption that the Dow Jones breaks above this resistance. We anticipated that it would pull back and find support on that resistance and then rally. So it's exactly what's playing out. I suppose just a little bit a word of caution as we roll through the top 50, what type of patterns we look for in particular stocks. The driver of the market at the moment is obviously the change in sentiment around whether 6 months ago the concerns were there that the US would be moving to negative interest rates and following Europe and Japan. Now what we're seeing, and this started well before Trump got elected, but we saw the US Treasuries begin to rally from around 1.3% in around June, and then obviously when Trump got elected, we've seen this next leg higher from 1.8 up to 2.5%. So as those yields move higher, that has a negative impact on yield-sensitive names on the ASX, so that'll be part of the focus of today's recording. Up on screen now is a graph of the XLF, which is the top 50 index, and not too dissimilar to the XJO. So we can see the market making higher highs and higher lows. We did get a little bit cautious or concerned when this low took out that prior low there. But now that the market's broken back above this high, I'd expect to see it find support on around 5,500 and hopefully continue with its upward bias. Moving into the top 50 stocks, let's sort of run through these and I'll give you a bit of an idea from a valuation. AGL, we've been long this stock from lower levels. We'd sold covered calls over it at around this $20.50 level. I think the stock's reasonably full value up here, 18 times earnings and a 4% dividend yield. Amcor, this stock's trading about 17 times earnings, just over a 4% dividend yield. The company was growing earnings about 8%. That's now going to be probably something more around 4 or 5%. On that basis, I think the stock's sort of $15 as fair value. We've been aggressive and sold $15.50 covered calls over Amcor to enhance the return. Not doing there in AMP at present. ANZ, so pleasing to see the Australian banking stocks have really all started to break out. Now, I might jump to a graph of the US equities there. At the same time, I'll introduce you to a new service that we're running for members, which if you visit blog.investorsignals.com, you'll be greeted with the homepage. And this is really just added commentary that supports what I talk about in these recordings. But if you scroll down, you'll see certain posts that come out of our algorithm engine. So we have a scanning service that picks up stocks that meet the technical patterns that I'm chatting about in the recordings. If you actually don't see these signals, click on it and you'll see a registration button there, and if you register you'll be able to get access to these signals. So again, visit blog.investorsignals.com. But if I just move in, you click on one of these signals, you go to the chart. I'm just going to bring up a chart of JP Morgan and just have a look at sort of this performance of these US banks. So there's JP Morgan. You can see over the last, say, 3 months, it's really gone from, say, $55 up to $85. So put on sort of something in the order of 30-odd%. If we look at Goldman Sachs, similar type of performance. So the US banks have done very well, is my point here. Goldman's from 160 up to 240. So the Australian banks are being dragged higher as a result of this performance in the US banks. But again, I struggled when I look across the next 6 to 12 months as to actually where the increase in revenue is going to come from. The only bank that really grew profit in the recent earnings result was CBA, which underlying growth was around 3%. All the banks are struggling to grow top-line revenue. So what we're really seeing here at the moment, and it certainly can happen where the equity market trades higher, and ultimately 6 or 9 months later, the economy starts to pick up as well. There's no shortage of examples of that over the last 10 or 20 years, where the share market really leads a pickup in global economy, global GDP, well before the actual evidence is there to say that that's happening. So I think you always got to sort of keep a positive outlook as to what's possible, but I think the way to approach this is to recognise which stocks are breaking out, which ones are still in a downtrend, and sort of where we see valuations getting a little stretched. So in the case of the banks at the moment, you have to clearly say that the momentum's up, but have that concern as to how far the rally goes. And this is, if the rally does have a number of sort of legs higher or time to it, then you'd expect to see a pullback and a buy on the dip type opportunity in the banking stocks. So here's the beginning of this change in these yield names. After a few years of the yield names doing very well, you're starting to see them break down, take out the prior lows, and for that reason, on most of these yield names, I think the FOMC meeting in the US regarding US interest rates is on the 14th of December, so on Wednesday in the US. What I expect will happen is we'll see a quarter-point interest rate rise in the US, but the outlook statement will dampen any expectations that there's quick successive rate rises coming in the US. I think if that happens middle of this week, we'll see the yield names rally, but I would sort of caution that it's probably a rally that you want to be looking at selling into as a way of lightening up on some of these yield exposures. So as I'll move through, I'll reference that, and we'll see the sort of consistency in the chart pattern. ASX struggling to grow earnings here at the moment, and it's trading on a high PE, but I think it's relatively defensive. On a 4% dividend yield, 21 times earnings, but I'm not sure they're going to deliver 5% earnings growth, so I think it really tracks sideways. AZJ, I think, starting to get expensive up here, and I have some concerns about its dividend sustainability. BHP we like. We've been long this trade. Really throughout this rally. In most cases, we managed to sort of squeeze through without getting exercised on the calls. In cases where we have, we've jumped straight back into BHP again. We've sold 27 calls now out into the early part of the new year and still trying to capture a little bit more of this upside. But you would have to think that sort of BHP is reasonably full value. I think sort of the outcome with OPEC is promising for oil prices, and that may be supportive for BHP in the weeks ahead. Brambles, so the technical structure here is negative, lower low, lower high, but at around $12.50, I think the stock sort of full value, and we sell covered calls up at that levels. It's trading 19 times earnings on a 3% dividend yield, so I think it definitely needs the covered call to complement the return. CBA breaking higher, as we looked at with ANZ. Coca-Cola back on support here. Stocks trading 17 times earnings on a 5% dividend yield. Again, don't expect too much in the way of earnings growth. Look to sell the $10 calls to drive extra income there out of Coca-Cola. Computer share, this is a stock that's benefiting from the higher interest rates and a strong US dollar, but I think up at around sort of 12.50, I'd expect this rally to exhaust, and it may actually provide a good shorting opportunity. CSL, keep this one on your radar. I think a sell-off here, and it's in a downtrend, so it's a counter-trend move that you're trying to buy into. Whether it gets down to as low as sort of $85 or find support here, but the outlook for CSL on a sort of 1 to 3 year basis still looks promising. Growing earnings minimum 10%, maybe as high as 15% per annum, but the market's really discounted these expensive PE stocks back from sort of high multiples, and we've seen them all sort of, whether it's Domino's, CSL, Bellamy's, A2 Milk. There's a whole variety of stocks on high PEs that have been ratcheted back. So even at the moment, CSL trades 25 times earnings on a 1.8% dividend yield. But given that above average earnings growth, I think it probably getting close to finding some buying interest in this sell-off at the moment. Caltex, 13 times earnings on a 3.5% dividend yield. I think it finds support at or near where it's at. So this is one of the few property stocks that's in a bullish uptrend still. But all these yield names, I think they maybe have a rally off the back of the FOMC meeting, and then they run into resistance. So Goodman Group here at this level trades at 15 times earnings on just under a 4% dividend yield. But GPT's probably been one of our preferred property plays. At this level, 15 times earnings on a 5% dividend yield. IAG, we've liked this name. We hold it in portfolios. We've sold calls up here. I think the insurance names may be getting sort of the top end of this rally at the moment, but interesting that IAG sort of looked like it was starting to roll over and move into a lower low, lower high pattern, and then it's broken out as a result of the company coming out and indicating that they're going to have I think a $250 million cost-saving initiative, and that their insurance margins are going to be roughly in line with where they were last year, and the market's rallied. So I have Insurance Australia on about a 5% dividend yield now. Incitec, this is another stock that's breaking out. So about 18 times earnings on a 3% dividend yield, but I think the outlook for Incitec continues to improve over the next 12-24 months. James Hardie, we own this in portfolios. We like this name. Exposure to the US housing market, I think that continues to do well. We have James Hardie on 26 times earnings and a 2.5% dividend yield, but growing earnings well above average. Lendlease, I think this stock looks okay here at 10 times earnings on a 5% dividend yield. It's certainly not expensive, and that's reflected by the concerns that the market has around unit settlement risk in Lendlease. But I think that may be a little bit overdone at the moment, and maybe there's a chance that Lendlease pushes a little bit higher short term. Medibank Private, so we like this name. We own it in portfolios. We've been pretty aggressive with selling the covered calls. I think the stock's pretty close to full value up here at $2.80. It puts it on 18 times earnings and just over a 4% dividend yield, and the company's indicated that they're not expecting too much in the way of earnings growth. Macquarie Group, so not doing it there at the moment. NAB, we continue to like this name, albeit across all the banking stocks. We're just getting a little bit concerned that they've been dragged higher off the back of the outperformance in the US banks, and if they start to tire a little, then I don't think there's a revenue or profit upgrades there to support the Aussie banks with this current rally that they're on. Newcrest, so gold's obviously underperformed as the US dollar's done well and interest rates have moved a bit higher. I think maybe there might be a slight bounce in gold off the back of this FOMC meeting, but I think maybe the trend for the moment appears to be sort of more as a corrective sort of down move in gold. Origin, so all these energy names I think are placed to be over the next sort of fortnight. I think with the OPEC and non-OPEC members agreeing to a cut in production, I think maybe oil can trade up to $60 a barrel. That should be supportive for Origin, Woodside, Santos, etc. So Oil Search, I think, is probably a buy down here. Could push up a little bit higher to around 750. Not doing there in Qantas at the moment. QBE's been a beneficiary of these higher interest rates in the US. And whilst I think it probably finds resistance here at around 12.50, I think this is a stock that you want to keep on your radar as probably over the next 12 to 24 months. If the US economy does start to pick up and these interest rate increases that we're seeing remain, then a company like QBE should continue to do well after it underperforming for the last sort of 5 or 6 years. Ramsay Healthcare, worth just keeping an eye on this one, back on support at $68. But given that it's trading 26 times earnings and on a 2% dividend yield, I think you need to run a tight covered call there. Rio, doing very well. Iron ore now pushing up to over $80 a ton. In that environment, I think we could see a sort of Rio deliver something in the order of a 3% dividend yield, even at the current prices. I think that continues to make the stock attractive. Scentre Group, so this is again one of these yield names, the interest rate sensitive sector being the property trust sector. The stock's 17 times earnings on a 5 and a bit % dividend yield. I think it can trade up to around 460, 470, and then we'd be wanting to sell covered calls there. Seek, look, we've mostly taken profit here on Seek, so we've traded this off this low here and we've taken profit in most cases, or sold covered calls over it. I really want to see the earnings result in January on Seek or February before we sort of get too bullish there. Stockland's not doing it there at the moment. Sonic Healthcare, we like this name. We own it at lower levels. We've sold the covered calls. When you're looking at the complementing this with a covered call on the other side of the February dividend, we're getting over 10% cash flow from the dividend and the option premium. Plus, we think the stock's got upside to around $23.50. Santos, not doing it there at the moment. Our preference being BHP and Origin. Suncorp, keep this one on your watch list, and I think this rally here could tire up at around sort of, hard to know, could sort of trade up and fill this gap maybe up to around 13.70, but I think that sort of given this structure sort of into a lower low here, if we see this starting to roll over, it could be a little bit bearish there for Suncorp. Sydney Airports, with these yield names, FOMC meeting maybe kicks these names a little bit higher. You can see they're at around 680. I think Sydney runs into resistance and you want to be selling covered calls. As with Transurban, look, whether it actually gets up to this 1150 level, so Transurban pays a 25-cent dividend at the end of December. The stock now trades on a dividend yield just over 5%. I think the stock sort of new range is maybe $10 support, but maybe doesn't do too much above that $11 level. Telstra, I think, is oversold down here. I think this could trade back up to around sort of 530 to 550 before we have a look at doing anything there on the call front. Treasury wines, the structure here is bullish. The stock's back on a support level around $10. From an earnings growth perspective, the company's delivering high double-digit earnings growth, and that should support a leg higher in the share price up to around 11.50. Westpac breaking higher. We've gone out and sold calls up around 33.50 over Westpac, and looking at capturing the upcoming May dividend there as well. Wesfarmers, so we'd sold calls at around $43, $44. They've mostly expire, and then we've reset them again out into May now, with a view that we get exposure to the February dividend. I think the concern with Wesfarmers is coal slowing down, increased competition. On the flip side, Bunnings is still delivering around 8% earnings growth, but I think on net, I think Wesfarmers at 17 times earnings and a 5% dividend yield, and maybe only 3-4% earnings growth. You want to be selling covered calls to complement the returns there. Westfield, so another one of these interest rate sensitive where we've seen them break down below sort of this uptrend structure that had been in place for a while. I have Westfield now 19 times earnings on a 4% dividend yield, so I think you need to be selling covered calls to complement the future returns there. Woolworths, it'll be interesting to see what the results look like in February for this business. I've got the stock now trading about 18 times earnings on about a 3.8% dividend yield, so maybe upside to around $25. Don't see it doing too much more than that. Woodside Petroleum, I think these energy names are pushing higher. Got Woodside about 18 times earnings on a 4.5% dividend yield, but I think we could see some upgrades if we start to see oil prices push up towards that $60 level following the OPEC meeting. And here we are back at the index. So before I conclude, let's just have a closer look at what we're expecting to have happen. So we recognize that this low has broken below. It looked like the market may be turning lower here, but given that we had such a strong structure in the US, we're unwilling to really sort of view it as a short signal, as the real leading indicator is still the Dow and the S&P 500, which remain bullish. Ultimately, that then led to the ASX breaking through sort of this negative structure or resistance level, and it appears to be wanting to push higher at the moment. It would surprise me to see the US banks move too much higher given the extent of the rally that they've already had. With that in mind, I'm looking more for a consolidation pattern in our market, and then maybe we get another leg higher towards sort of late December into late January, and we would have some concern that the US market maybe, if it continues to perform well up to that January period, I think that it just needs to be a review of portfolio allocations, especially I think towards growth stocks at the end of that January period, and that'll be a focal point of the first market recording that I do in the new year. So again, if you have the time, please log on to the blog.investorsignals.com website and have a look at the additional research that we provide there. And wishing everyone a Merry Christmas, and I look forward to speaking again in the new year. And if you'd like to know more about the Investor Signal service or just have a chat with me about the market, please don't hesitate to contact me using the details on screen. Thank you.